Hi, I'm Simeon Wallace, Chief Investment Officer of Aprio Wealth Management, and welcome back to The Pulse, where we take a month-to-month look at what happened in the economy and the capital markets so you make better decisions in your business and with your investments. Let's start with the highlights. The real story is the changing leadership in the markets. Emerging markets and small caps have been strong in June, with emerging markets now up nearly 30% this year and small caps nearly 20%. In contrast, larger AI CapEx-driven companies, such as the mega-cap tech names that are spending big on data centers, have been weaker this month, though still positive in the quarter and year-to-date. Despite inflation concerns and the new Fed chair's comments last week, bonds have been relatively calm for the month, with some progress this quarter. Now, in contrast, the key move has been oil, down 12% in June as the Middle East tensions potentially cooled on hopes of a resolution. Quiet on the geopolitical front eases the inflation pressures ahead. Now, the build-out of AI is playing a big role for company margins across the economy. Last quarter, over 80% of companies grew their earnings year over year, the highest number since the pandemic rebound. Investors are showing a strong appetite for risk. Since last spring, small companies that are losing money, in other words, the most speculative ones, have seen their stock prices outperform those that are profitable. This investor behavior tends to show up when confidence is running high. Now, with ISM readings above 50, the manufacturing and services sectors of the economy are both expanding. The underlying U.S. economy has been stronger than many headlines imply. One of the key reasons, Americans are spending. In fact, they're spending at nearly the strongest pace in 30 years as retail sales are up more than 9% from a year ago. Consumer behavior keeps the broader economy moving. Now, last month, headline inflation came in at 4.2%. Energy drove that, and the Fed is reacting to it. Yet, more real-time data tells a different story. Goods inflation already looks like the worst is behind us, while other forms of inflation have been trending lower. Blackstone sees inflation becoming less of a factor. When looking across its hundreds of portfolio companies, and as one of the largest real estate owners in the US, the team at Blackstone sees real shelter costs and wages are already cooling. In other words, anecdotal data is confirming what trueflation was just showing. Yet the inflation picture is not perfect. Supply chain pressures have soared to a multi-year high. If you're managing a business, this means higher goods and input costs may potentially lay ahead. Last week, we heard from the new chairman of the Federal Reserve, Kevin Warsh. It was expected that his bias would be to cut interest rates. Yet with the economic strength that we just alluded to and the recent higher inflation headlines, Warsh sounded hawkish, and the two-year yield jumped above the Fed funds rate. Historically, investors consider the two-year a leading indicator to where the Fed takes interest rates. To wrap up everything from today, here are the key takeaways. Earnings are broad and the economy is still growing. Inflation is cooler underneath than headlines suggest. And the real change is a Fed leaning hawkish, so plan for the cost of financing to stay near current levels. With that, I'm Simeon Wallace, Chief Investment Officer of Aprio Wealth Management, and I'll see you next time with our next edition of The Pulse.